Confusion surrounded last week's inflation data as some figures aligned with expectations, while others, like core inflation and personal income, diverged. It left analysts unsure how to interpret the overall economic picture. Joining us right now to hopefully shed a little light is Nick Timiraos. He is the Wall Street Journal chief economics correspondent. And Nick, lots of people were surprised by how those numbers came out last week. What do you think happened?
Well, I think the surprise was just around the size of the flows, the trade flows on the trade deficit, and coming up with a forecast for these things right now. I mean, it's not quite as difficult as 2020 COVID, but we're running a policy experiment we haven't really done before. So I don't know how you come up with a consensus expectation for any of this. I mean, the bottom line is that the economy looks okay. I think the worry would be that it's a lot easier to see the headwinds right now than to see where the tailwinds are going to come from. On the inflation numbers, Becky, I mean, 2.1% headline PCE, 2.5% core inflation. If you went back 2 years and you told Fed officials in the Martin building, you're going to have 4.2% unemployment rate with the inflation rate coming down like this, and you'll have cut 100 basis points, I think they would have given their left arm for that outcome.
But then you've got Fed officials like Waller saying, hey, we're in a pretty decent situation here. These numbers are pretty good. You've got Austin Goolsbee saying things like, well, look, maybe we could cut rates sooner if we can see through some of what's happening with trade at this point. Are things a lot better than had been expected? And when do we finally get numbers that we say, OK, this is a real read? You can't write off numbers for forever.
You can't. I think the interesting debate right now is around answering this question. What is going to nourish inflationary pressures beyond a one-time increase in goods prices? So you're right. Chris Waller in Korea on Sunday night laid out the dovish argument quite well. You can tell somebody from the University of Michigan, I think inflation is going to be 6 or 7 or 8% next year. But if you go to your employer and you try to get a 6 or 7 or 8% wage increase right now, they're going to laugh in your face. So his point is, you know, what's the mechanism to sustain a rise in inflation expectations through the wage channel? This is not 2021, where housing was overheated, where labor markets were overheated, and where the funds rate was very low. This is a different situation. You know, the other argument Raphael Bostic at the Atlanta Fed made yesterday is, well, the way that we're rolling out these tariff increases, you can't just assume this is a one-off. You're doing it in a way that could mess with the psychology around inflation. I asked Steve Moran, the CEA chair, last week for an inflation forecast this year, and he wouldn't provide one. He said policy is too unsettled. So you could argue, you know, that is not price stability when people cannot forecast prices a year ahead.
Nick, can you just go back to that trade deficit number and explain it a little bit? Is it possible that the previous month people were front-end loading and that they had already done it? Or because the expectation, I thought, was that it was even going to be wider than expected because everyone was going to be trying to stock up on things before the tariffs hit. Instead, it was cut in half, which if you were a total optimist or a half-full person, you'd say, oh, my God, this stuff is already working. It's already working that we're importing less. Is it going to be revised up? Is the next month going to be a huge number in terms of the deficit? What's happening?
You know, those are the right questions. I'm not sure we know. You look at some of the port traffic data and you thought maybe you'd see a big resumption of shipping after the honeymoon in Geneva last month, and you haven't seen it. So, you know, I don't want to look at GDP now and all of these real-time trackers right now until trade flows settle out. People drove themselves crazy looking at the big negative numbers in the GDP Now series last quarter, and I think you can drive yourself crazy looking at the big positive numbers right now. It's almost like you just have to set all of this to the side.
So we have AI, and we're even worse off in trying to tell you what happened. So we still don't know, and AI is useless, and you can't help me. So did you look into the actual numbers, and were there weird things that's like the GDP number? We know what happened with that. How did we cut the trade deficit in half?
Well, you cut it in half because imports fell a bunch. I mean, I don't think there's much mystery there, right? We imported a lot in the first quarter, and then we cut off the trade flows in April, and now you're seeing the other side of that. And I think the big question is, what kind of a rebound do you get? The big question for the Fed is going to be, do you actually see a pass-through right now of these prices? So I think the big question for the June FOMC meeting, you won't have seen it. I mean, we get one more inflation number, but you probably won't have seen a lot of the tariffs into prices. You have to put down an inflation forecast. They're going to do another SEP at this meeting. So what's in the inflation forecast? Do you change the interest rate path for this year based off of, a lot of policy change, but not a lot of real data that's telling you this is happening?
Americans never stop consuming. So if we didn't import it, we're making everything here already, Nick. It's already happened.
We spent a lot on
services. We're depleting those inventories.
Okay, we're depleting the inventories. Okay, that
Nick,
we already.
Do you think the Fed will cut rates the second half of the year a couple times?
You tell me what happens with the labor market. It really comes down to that. This idea, Chris Waller's clearly on an island right now with this good news rate cut story. You can tell the story, but you've got to get other people to come along. And the rest of the committee right now, you hear them communicating, we're okay staying here until we see something happen. And the something happen is the labor market cracking. And so until you get the unemployment rate moving up, it is very hard to see this Fed cutting interest rates.
So the Friday jobs report is really important. The ADP report is very important. We're going to be watching all these numbers really closely.
Yeah, you'd want to see not just 1 month move up in the unemployment rate, but a couple. So, you could rule out, I think, a July rate cut with a decent report this week. It's hard to see what gets the Fed to cut interest rates if you don't have spending weakening, claims moving up. And so, again, I think the question for the June meeting is, what are they going to write down in that rate path? The path of least resistance would be to just stay where they were in March. They had 2 cuts as the median in March. You could just stay there. Why move things around? You're providing some false precision that you don't have. The minutes last week said they had the staff revised up the inflation forecast. They don't do that lightly. And the FOMC anchors off of the staff forecast. So if you think inflation is going to be higher this year and you might not be on that path back down next year, you take cuts out in the 2025 rate path.